Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss market seasonality and what it means for long-term investors. First, what is seasonality? Well, you may have heard market phrases such as sell in May and go away or the January effect. These are observations about how the market has tended to behave based on the calendar. These patterns are interesting to talk about, and it's natural to wonder if there's something to them. After all, if investing were as simple as following the calendar, it would make things a whole lot easier. But as we will discuss, separating genuine investing principles from coincidence is one of the most important skills that a long-term investor can develop. Over the next few minutes, we'll unpack these concepts and discuss how they do or don't affect investors. First, let's look at the historical data on seasonal patterns for large cap stocks like those in the S&P 500. When you look at monthly returns going back to 1928, certain months do stand out. For example, May and September tended to show negative average returns in the 20th century, while December and January were often strong. It's natural to see this and wonder if we can't just invest during the positive months. However, since 2000, many of those same months have actually generated positive annual average returns, reversing the earlier pattern. So either investors changed their behavior after identifying the trend, something structural shifted in the market, or the pattern never truly existed in the first place. This concept is sometimes described as being fooled by randomness. Because stock returns are hard to predict, any historical stretch will naturally contain periods that look better or worse than others. This is true even if there isn't an underlying reason for those differences. If you were to flip a coin 100 times, you would naturally expect to see stretches of just heads or tails. The same can be true of the stock market. Small cap stocks tell a similar story. The original research on the January effect actually focused on small caps. This is the idea that stock prices tend to jump in January, which we can see was the case on average before 1999. Whether it's due to random chance in the data or whether it's a real phenomenon depends on whether there's something driving these returns. Researchers proposed many explanations over the years, from tax loss harvesting to portfolio managers adjusting their holdings at year end. Whatever the reason, the January effect has largely faded in the decades since it was first identified. One pattern that does stand out more in recent data is that September has tended to be a difficult month. But when you look at it closer, this is heavily influenced by a handful of extreme events: the dot-com bust, the 2008 financial crisis, and the 2022 bear market. These downturns didn't happen because it was September. They happened because of underlying real economic events and market conditions. So, if seasonal patterns aren't reliable, what should investors focus on instead? As this chart shows, the stock market has grown significantly over the past century through wars, recessions, financial crises, and pandemics. This long-run growth isn't driven by surface-level patterns. It's driven by something much more fundamental. Namely, business cycles spur corporate investment and consumer spending, which in turn support corporate earnings and stock prices. Staying invested across asset classes like stocks and bonds has not only kept pace with inflation over time, but far surpassed it. That's the real principle at work here. The temptation to time the market, whether based on daily price movements or seasonal rules of thumb, is completely understandable. But staying disciplined, saving consistently, and sticking to a long-term financial plan are what have actually worked over time. We hope you found these insights helpful. If you would like to discuss long-term investing principles or your overall financial plan in more detail, please don't hesitate to reach out. We look forward to speaking with you.